Good evening, everyone. Welcome to Asala's Classroom Talks, where we mentor future lawyers, we foster critical thinking, and simplify the law. Tonight, we explore a topic that touches on millions of Kenyans. Is your mobile phone now a tax office in your pocket? Kenya is a digital leader in Africa. We have seen ourselves evolve from mobile money banking, and now we are on online platform entrepreneurship. This growth has seen itself transform the Kenya Revenue Authority, which has expanded its tax net to target online sellers. From digital service taxes to VAT on all online sellers is being enforced. The questions that arise include, for example, are these taxes fair? Are they proportionate? And is KRA encouraging innovation while enforcing tax compliance? To join us to unpack these questions is none other than the in charge of digital platform taxation, Mr. Nixon Omondi. Over to you, Mr. Nixon Omondi. Most welcome, the manager himself. Please introduce yourself to the audience.
Thank you very much. Allow me call you Mwalimu because you are.
Yes, please.
Yes, this is Nixon Omondi from Kenya Revenue Authority, in charge of the taxation of the digital economy. So my day-to-day work revolves around ensuring that non-residents, and maybe in the course of this session, we'll be discussing and highlighting what is the meaning of a non-resident who at least gets some income from Kenya, also pay a fair share of what they are deriving from Kenya. But I know as lawyers, and I'm happy you've mentioned these very good words in jurisprudence in terms of fostering a critical thinking, whether the taxation is fair and proportionate. I'm sure it will come live in this discussion. Thank you, Mwalimu.
Thank you very much, Nixon. And now perhaps let's begin from a broad picture. Yeah. We have seen Kenya move from, digital service taxation to significant economic presence tax in a very short time. What are these tax regimes and how different are they?
Thank you so much, Mwalimu. In the traditional sense, and I'm sure given that I'm in the presence of learned friends, if you look at the work of the four economists, I'll not mention them for now. In 1927, when the OEEC, that was the Organization for Economic Cooperation, sat down and they thought of the world is becoming a global village. How do we ensure that people are taxed in a way that foster economic growth and also encourages businesses cross-border? They came up with two ways of taxation. And some of you who know about the theory, we talk of residence basis and the source basis. At that time, everybody knew that for you to do business in another jurisdiction or another state, you had to be physically present in that state. And that is why when you look at our definition of what a resident means, it definitely speaks to physical presence. But this has been challenged over the course of time because currently we are looking at an entity outside Kenya doing business in Kenya without necessarily setting foot in Kenya. But these businesses are also deriving value, they're deriving income from our jurisdictions. So look at it this way, Mwalimu.
Yeah.
In the olden days, if you are as old as myself, we used to watch films and cinemas brought to us by the Kenya Film Corporation. Later, it went into the theaters. So you'll go into Fox Cinemax, or you go to Kenya Cinema, the famous meeting point, Kenya Cinema, and watch your favorite cinema. And those people, the providers of the cinema, would
Yeah.
receive income and declare the same income to the revenue authority. That has gone away because the cinemas have been replaced by something of a flex, okay? Where you just have your gadget, have your bundles on, and you're able to watch your favorite movie. What does that mean? The same people, the economic activity still goes on. It's only that it is now being carried out by somebody who is not within this jurisdiction. How do we ensure that both people, the person outside and inside, they're deriving income from the same country, they also contribute to the development of our country? And that is how digital service tax was born. So digital service tax is a tax that touches on the digital economy, specifically for those who don't have physical presence in Kenya, but they do derive income from Kenya. So digital service tax started in 2021, 1st January. It operated up to 26th of December 2024, when, of course, there was a change in law, the Income Tax Act, Section 12E, which then changed it to significant economic presence tax. Just a quick difference between the two. Digital service tax is a tax on the gross transaction value of the services provided by the non-resident. So if somebody provided 100,000, DST would be, with the rate was 1.5%. So it will be 1.5% of 100,000. So if my math doesn't get me wrong, it's about 1,500. And that would be the tax. When you look at the significant economic presence, it talks of you must have some significant presence. For technical tax experts, significant economic presence tax equates to having a digital permanent establishment. You have a meaningful footprint, a meaningful presence within Kenya. And so that is how significant economic presence has been structured. And instead of charging the gross income, it charges tax at the same corporate rate like other taxpayers, which is 30%. Then, to ensure that we don't get into the complexities and the intricacies of determining the profits of a non-resident, it assumes that a non-resident makes a profit of 10%. So the taxation now is based on 30% corporate rate of 10%, which is a deemed profit by the non-resident person. So that is one of the difference between a significant economic presence tax and also DST. The second one, and the quick, is that if you look at international instruments, and I want to invite this very good audience to review the work of the inclusive framework, which is being led through the OECD initiatives. There was a document known as Draft Multilateral Convention on Amount A, which tends to preserve certain measures, such as significant economic presence tax, which is deemed to be aligned to international best practice in terms of taxation. DSTs are deemed to be, one, discriminative, tends to charge the gross transaction value, which is almost similar to indirect tax. And of course, globally, they have not been very popular. And that is one of the reasons then Kenya had to move from digital service tax to significant economic presence tax.
Wow.
Thank you.
Thank you very much for making that basic understanding and the distinction between the two. And now, Nixon, you mentioned the fact that you impose tax on the gross transaction. Why does KRA impose tax on the gross transaction value as opposed to the net gains of these companies?
Mwalimu, allow me to clarify something.
Yes,
KRA, we are part of the ecosystem in taxation. Our role as KRA is to implement the laws that have been made by Parliament. We know it's a constitutional mandate of Parliament to make laws, but our principal, which is the National Treasury, is the chief policy-making organ. okay, in terms of revenue bills and money bills and things to do with taxation. So as we also give our proposals, just like any other stakeholder, in line with, of course, the constitution. And so the laws are basically made by parliament, but they get a lot of input, not just from KRA, but from all stakeholders, whether they're advisors, whether they're academicians, including what goes through on the floor of parliament. Now, there are reasons as to why sometimes policymakers recommend taxation on a gross basis. One, taxation on a gross basis is a simple means of taxation. One example is the turnover tax, currently at 1.5%. Most people are not accountants, and maybe they might not have enough resources to hire a technical accountant to help them in doing financial statements. Remember, financial statements, Mwalimu, also have to be done in line with the International Financial Reporting Standards, a very huge document and complex. So a simplified way of dealing with taxation of small taxpayers is to initiate a gross basis of taxation, but at a very reasonable rate, so that their economic situation in terms of business is also not negatively impacted. So the gross basis of taxation is really not to collect a lot of tax or not to injure certain businesses, but it's just to ensure that taxation is simplified. Because if you look at the net basis of taxation, it depends on actually doing a profit and loss account. You need to have your profits. You need to know how to compute your depreciation and your wear and tear, and a lot more other details that will be too complicated for small businesses, and it will even be more costly. So that is the reason why you see a simplified gross basis of taxation. And also, keenly, when you look at most rates, whether you are looking at the TOT rate, which is 1.5%, the digital service tax rate, which was 1.5%, any other gross basis of taxation, you see that the rate is as low as possible to approximate, to make sure that there's a bit of equity between small and big businesses in terms of payment of the taxes. Because again, you don't want to, same business, maybe different sizes, you want one to pay more. No, comparatively, they should be shouldering their fair share of the tax burden. And so the grace basis, again, was not just born from a KRA whim. It's, if you look at what had happened in Europe, UK, Italy, Hungary, India with the equalization levy, Tunisia was the first country in Africa to come up with the digital service tax. All of them had proposed a digital service tax based on a gross basis. And therefore, the policymakers also did not want to reinvent the wheel. They wanted to use what is already working, what is simplified. And then my final point on that, if you ask a non-resident, let's say XYZ company operating globally in 500 or so countries, then you ask that company to pay their profits on their taxes on the basis of their profits, a lot of complications will arise. Will they file their returns in Kenya, declare the profits from Kenya? How will we even validate their costs? Because their offices are also not in Kenya. It brings a lot of those complications, and that's why the gross basis becomes a way out. It might not be the optimal, but it is a more simplified way of taxing the non-residents. And that's why the digital service tax was framed that way.
Thank you very much, Nixon, for that clarification. And now, if I hear you well, is it that when KRA introduced the digital taxation platform was merely to align to, the framework, the international framework, or was there any particular unique problem that KRA was seeking to address?
Malim, allow me to take you back that KRA is just part of those who are stakeholders in the tax ecosystem, but the law is made by Parliament. So when Parliament came up with the digital service tax, it was to address the issue that we had talked about as I was introducing the topic, that businesses have moved from what we call brick and mortar to the digital space. Mwalimu, you can remember not more than 15 years ago, if you wanted to get your software, even the Microsoft Office, you had to go and buy a disk, a CD-ROM, okay? And the CD-ROMs will come to Kenya through the port. So it means somebody was involved in the business of importing the CD-ROMs and selling. And the person would get their profits out of that business and the amount of tax charged in Kenya. When that stopped, where you don't have those physical storage devices or physical devices that transmits whatever service that you want, the business now became directly from the non-resident person. Whatever you want is relayed directly to your laptop. What happens? The same person is still deriving income from Kenya, but the person is not directly visible, is not directly relatable in terms of taxation of brick and mortar that has been there. If you look at taxation of business income under Section 4 of the Income Tax Act, it talks of a resident person. If you do business partly or partly outside, then you got to pay the tax. But this is a person who is doing business in Kenya. The person is not a resident. How do you then catch up with that person? And that is why, in the wisdom of our very good parliamentarians, the digital service tax was the only way in which the non-residents who are also deriving income from Kenya will also pay their fair share of tax. Look at it this way, Mwalimu. If today I start a software company where I'm able to do coding and have very good software for use in various places, the laws in Kenya requires me as a good citizen and part of constitutional mandate to pay tax on the profits that I derive from that venture. If you tell a similar person who is providing similar product, a non-resident, not to pay, what does it mean? It means you are favoring a non-resident, get income from Kenya and pay nothing, but your own resident is paying. That even goes against the natural justice and fairness in terms of even competition. It means I cannot compete with such a person on an equal footing. So it was also fair to ensure that all businesses, whether you are in Kenya or you're outside Kenya, if you're deriving any income from Kenya, then it is only fair that you also shoulder, a part of the tax burden. So you see many reasons. The issue of other countries also coming up with the rules is again to address the same issues that we are saying. One is digitalization of the economy, and two, to create an environment that is fair for local businesses and international businesses alike.
Okay, thank you very much, Nixon. And now, as you're speaking, I'm thinking of blockchain transactions, and how practical it is to enforce these tax regimes on blockchain transactions. Perhaps you can share your views on this.
The advantage with digital economy and digital transactions, they leave a lot of footprint. Okay? And for a tax authority like Kenya Revenue Authority, whenever there's a footprint, it enhances compliance, follow-ups, and where it is very extreme, then enforcement, because that is usually a last resort. There are many ways of having a footprint of blockchain transactions. One is through collaboration with other countries. Okay? So that has been robust. Many countries have come together. There is actually a whole framework of sharing information across jurisdictions through what we call crypto reporting asset framework. So if there are crypto players in the US or Kenyans who are having transactions in the US, that can be shared. And vice versa. Kenya can equally also share similar. But much more, there are also digital tools that are able to track transactions that are happening in the digital space. How? Some of the very good providers are connected to the exchanges where people can buy and sell their crypto assets. So those exchanges definitely have full information of Asala was buying so much Bitcoins or Ethereum at this price on this day, and they kept it and sold it at this price on this day. So there's a lot of digital footprint, which is useful in tracking the transactions, in knowing even how much you want to tax, and whether there is compliance or non-compliance. So to me, it's not a very difficult field to venture into. It's only that maybe Kenya, for example, has to invest in that technology that can track and trace, and also get into agreement with those other countries for purposes of sharing or exchanging information on the same.
Thank you very much. And I notice we are already now discussing these digital assets. You're talking about crypto, we are talking about blockchain. And perhaps for the sake of our audience, Kenya has a vibrant crypto fintech community, but what are these forms of assets? Could you just perhaps in a brief summary inform our audience what these assets are?
Mwalimu, allow me not to pretend that I'm a very tech savvy and talk about the blockchain. But let me explain the little that I know in a layman's language, and I hope our audience will pick a thing or two. There are many assets that occur in the blockchain. And I'm happy that I've engaged some legal minds who are also working on the blockchain technology, even to secure issues around title deeds. We all know how important a title is for those who remember their land law and property law. So the blockchain technology is not just for coming up with tokens and coins for purposes of exchange, or to use them as a store of value, or to use them to buy something. But you can also use that technology for other purposes in documentation and many other things. But coming home to the most common assets within the crypto ecosystem, we look at the coins. Okay, the coins that people have to come up with through a process called mining. So somebody has to invest in technology, somebody has to invest in power, somebody also has to invest in very good computer, I don't know, I call them computer geeks, who are able to crack algorithm using a lot of power, and computers with a lot of storage and computing power, again, to extract the coins. So the moment you are able to extract that coin through that intricate process, you can use that coin, one, to buy a good or a service. Okay, you can use your coin to buy coffee. Maybe not very popular in Kenya, but it happens somewhere else. At the same time, you can keep your coin somewhere. You can sell it to somebody else who then waits for prices to change. And then you can sell them just like you buy and sell shares at the Nairobi Securities Exchange. So you see there are a lot of use cases for these coins. So Kenyans generally in the crypto space, they buy the coins, and then whether for speculation or for whatever reason, they keep the coins. And when prices change, of course, the prices can go up or down. They then sell those coins. And there's many coins, maybe, I don't know, over 1,000 types of coins or even more. I might not have the figures here. And you can buy any coin any day, whether it's a Litecoin, whether it's a Bitcoin. There was also a proposal for a Kenny coin a few years back, which was a Kenyan-based crypto coin. And then you keep it, just like you can keep your shares or you can keep your dollars. When the foreign exchange or the exchange rates favor you, you can then offload them into the market, make some money. Of course, you can also make losses and things like that. So that is, in brief, the kind of crypto asset that we look at in Kenya. But much more, you can sell those assets through various mediums or through various providers, the people we call exchanges. So there are many exchanges as well, I think more than 1,000. You can always choose which one you think works best for you. You can have a wallet on your phone. You can use your computer. I don't know whether you can still use USSD, maybe not, but you can sell or buy the coins based on your preferences and how much money you basically have. So that's basically the crypto asset in Kenya.
Wow, thank you very much, Nixon. As you're explaining what these assets are, you create the impression that their nature is very volatile, yeah, as assets because they fluctuate all the time. So I keep wondering whether, how KRA then manages the aspect of valuation and the timing of their taxation whenever we see them in transactions. How do you deal with this?
If you look at the law, there's been a change in law. There is a pre-September 2023 law, which was then amended in June 2025. And currently, there's no specific law dealing with cryptocurrency. Let me explain the three regimes. So pre-September 2023, there was no specific mention of cryptocurrency. Some people just call it Bitcoins, but Bitcoin is just one of the cryptos that are there, one of the tokens that are available. So before that period, many people have thought that then crypto was not supposed to be taxed, which I think is not, should not be the truth. If you look at the definition of the word business, it generally covers you buying and selling cryptos as part of your business. If you look at the definition of property, and I really don't want to take you to the IGA, the Interpretations Act, but again, property is defined in the 8th schedule to the Income Tax Act. So there are two cases. Either you are holding the Bitcoins for long, in which case capital gains tax might arise, or you continually trade on the Bitcoins or the coins such that then you are in the business of doing it, because there are also intricacies in terms of what is a business and what is not. And therefore, it was taxable. But we felt that because of those complexities that you've mentioned, Mwalimu, how do I value? When do I value it? How do I translate them? What value do I translate them to? Remember, in the crypto world, you need to move a crypto to maybe to a stable coin, then to a fiat. Or the fiat is what we generally know as the Kenya shillings, the US dollars, the euro, and all that. Or you can also do the reverse process. So we felt that it was easier for our Kenyans, our citizens, to comply with the tax laws if we bring in a gross basis of taxation, okay? Where, one, we ask the platform where people exchange that if Nixon is going to sell their 5 Litecoins, okay, then just take a portion of that and pay as tax without necessarily doing any other secondary or second processes. And that was a simplified taxation regime for those who are trading in the crypto space. So you don't need to worry whether it's a capital gains or it is a business subject to either personal income tax or corporate income tax. So it was a simplification of the regime. And that is to avoid the issue of valuation, the issue of Forex, the issue of when do I need to pay? Because I have my Bitcoins I bought in January. By March, I want to off-ramp. I want to sell them, offload them. Okay. Do I wait until I pay? Do I wait to pay for the money in 2027? April, the balance of tax due date and such kind of complications. So the issue of valuation, I think, was taken out. But now when Parliament, again in their wisdom, deleted that section, section 12F, that was dealing with taxation of digital assets, it means we go back to the default, where if you are trading in crypto, you need to make a call whether it is a capital gain, which is subject to capital gains tax, or it is a business venture, which is then subject to the normal personal income tax at 30 or the graduated rate, or if it's a company, you're looking at the corporate rate of tax. And the valuation will be very difficult. But Mwalimu, when we did away with foreign exchange controls in 1990, was it 89 or 90? Yeah? It means it is you to determine the foreign exchange gain, so long as it is reasonable. And you can point that my Forex rate came from the CBK rate or this commercial bank, or it came from one of these third, service platform providers like Oanda, S&P, and all those other bodies. So it is you to determine, so long as the exchange rate used on that day of payment of tax or when the tax is due is reasonable and verifiable.
Yeah,
Yes.
thank you again, Nixon, for that explanation. And as we talk of applying taxes on gross transactions when it comes to these digital assets, also asking myself, are we not posing the risk of looking like we are aggressively taxing the traders involved in crypto and blockchains, and as a result, we might easily, push them to offshores and other or underground altogether.
Thank you, Mwalimu, for that question. The fact that its taxation will push you offshore, I think you are just running from Kenya, because when you go to India and other countries, you'll find a similar tax, even higher than Kenyan, and even more stringent rules around them. That is one. Number two, taxation is already provided for. That is given. Whether we have a digital asset tax provision or not, the law as it is now requires you to pay a tax. The difference is, if the law is left as it is now, then it means, Mwalimu, if you have your 2 Litecoins, you need to track how much did you buy them for. If you sell them in May, how much did you sell them for? What profit have you made? If you use the same amount to buy Ethereum, how much have you bought for them for? Then when you sell them in August, you also track that. What profit did you make? What loss did you make? If you now go and buy Dogecoin, then you also keep such a track. How many Kenyans will be able to keep up with that? Okay? So what the law was doing is basically to make it simple for you, to lower the administrative burden by our citizens to pay tax. I'm sure, Mwalimu, you've heard of proposals by the ministry to introduce a daily tax in line of convenience and ability to pay, which we always borrow from the Adam Smith 7 key rules of a good tax system, because we want to make payment of tax as simple, as convenient, and also when you have the ability to pay. If I had my 4 Litecoins today, or let me say I'm fortunate to have 4 Bitcoins today, that one I would be worth well over, is it 40 million or something like that? It would be some very good millions. If I sell them in the next 2 months and I make 1 million, then you tell me to come and pay that tax in 2027. Will I even have that money then to pay it? So that is why policymakers keep balancing between not affecting the industry negatively, so that people start going underground, people start doing offshore transactions, and also making the process simple for everyone. And much more. I think sometimes tax also boils down to patriotism. If who is in a class and the salary is being taxed, and you've chosen that, no, now me, don't want to teach, I want to go into the crypto, I want to buy, sell, speculative or otherwise, then it's also fair that you also shoulder your own fair burden of tax. And that is what we always engage. And we are always ready to assist taxpayers where they have complexity, like the ones that we are explaining, so that we can always assist. Yes.
Thank you very much. And now let's look at, the privacy and surveillance of these transactions, because digital taxation relies on data. Yeah, we have transaction data, platform reporting, algorithms, and I would just like to hear from you. To what extent does KRA rely on automated data to identify non-compliance?
I can assure you that our section 59, including 59A of the Tax Procedures Act, provides on rules of course, that's Cap 469B, on how we ask for information. So as it is now, KRA doesn't get bulk information and then we start fishing. We know that Nixon transacted this much. We will call for that specific information and information that is only relevant for tax purposes. So we can ask you to provide for the information, just as we always do in the traditional audit and compliance sense. If we feel you've not maybe declared your full income, we can ask you to avail your bank statements to validate what you are telling us. So that is the same scenario. So if we feel you have so much coins, we can ask you to give us evidence of basically how much you owe. And that is within the tax realm. We are not going to ask you, oh, give us the address of so and so who you sold to or you bought from. So the information is basically what is what is useful to assess tax, not any extra information that would go against the Data Protection Act and of course the general privacy requirements of the Constitution. So what we basically do, if you look at the issue of digital asset tax, it is the platforms who are deducting the tax and remitting. So KRA will not get information in terms of, oh, this person is coming from which country and how, and all those many details. So they will just say that this is Nixon Omondi in this month or this day, he sold his 5 Bitcoins, this was the amount, and this is the tax. So unless maybe there's something privacy or something going against the Data Protection Act, then of course we can always discuss that.
Okay, thank you very much. And these invisible audits, that are conducted through algorithms can be made accessible to anyone should they contest.
Definitely.
Is it
Definitely,
a transparent process?
Let me explain something, Malimo.
Yes.
I don't think we've done any audit relating to data or algorithm without the consent of the taxpayer, and in the presence of the taxpayer. We also carry out what we call systems audit. So we can come to your company and look at the billing system, just to be satisfied that the billing system gives report full account of your transactions. And it means, one, you are the one who is going to give us the access, and two, you have to be present as we do that access. So everything is open to the taxpayer as well. But I can assure you that I don't think we've done any algorithm-based tests and audits on people, especially from where I stand. Yeah.
Okay. Thank you.
Yes.
Thank you very much, Nixon, for this kind of enlightenment. Yeah, it's such a learning process, I'm sure, for me and the audience as well. Now, let's look at the fairness, of your digital taxation system between the small traders and the big techs. Yeah. And I know you and I are aware that thousands of Kenyans, sell products on Instagram, Facebook, WhatsApp, and all other marketplaces, that exist online. But at the same time, you have, I think, already mentioned this, that we have these global digital corporations that generate significant revenue from Kenyan users. And my question following on from this would be, how does KRA differentiate that this is a global corporation, digital corporation, that is completely different from a youth in Kenya selling clothes online? How does KRA separate or differentiate these two?
Thank you. It's a very long question, but I'll see how to give it a good approach. When digital service tax was introduced, many Kenyans used to ask, if I sell my clothes online, am I going to pay digital service tax? Okay. Then number two, if I sell my clothes online, what taxes do I pay? Those questions are worth $1 million. Okay. One, digital service tax, as the name suggested, was a tax on service. And the law was very clear that it was a tax on non-residents or the multinationals who are operating in Kenya without physical presence. Number two is that the taxpayers were required to self-register and pay based on, of course, our self-assessment regime. So that was very different from the taxation regime of a youth in Kenya who is selling shoes online. If you are selling shoes online and the platform is a Kenyan platform, owned platform or owned by a resident of Kenya, the two people, the seller, the youth selling the shoes, and the platform will be taxed based on the normal taxation regime. But if you are selling through an online platform owned by somebody outside the country, a non-resident, then the person offering the service would be offering digital service. And therefore, they will be subject to digital service tax, but not you who is selling shoes, because shoes is not a service, it's a good. Okay. I know sometimes there are nuances around goods and services. So there's a very clear day and night difference between somebody selling goods online and the online platform itself, and an online platform that is owned by a multinational. Remember, if you're a youth selling good merchandise or anything online, the law still requires you to account for your tax. But there's a level in which you will not pay any tax. For example, if your income in a year is 288,000 and below, you'll end up not paying any tax. But if your income is between 1 million and 25 million, you can actually register for a simplified taxation regime, which I mentioned earlier, called turnover tax regime. The one that will not require you to do financial statements, come up with your profits and pay based on the profits. It's a simplified one. Every month you just calculate how much did I sell? 20,000. 20,000 times 1.5, then you pay your 300, actually 300 shillings, and you finish off with that month completely. Then you go to the next month in that order. So that will be the difference between the two taxation regimes. But for digital service tax, it will be paid by the multinational who is outside there. They will know how much they derive from Kenya and charge 1.5% and remit the same to the commissioner based on the dictates of the law. So that will be the short way of answering that long question. Yes.
Yeah, but I'm also thinking of people who are in the Airbnb business, yeah, and especially for the youths. And this model, as you said, it's the multinational that, pays taxes. But the practice that we see is that they withhold a percentage of your tax, every income, yeah, gross income. So they withhold and remit to KRA. But then we are not sure if these youth will make profits or will, get to the threshold where they are required to pay taxes, yeah, at the end of the year. So how do you explain this to someone who is in this kind of dilemma?
It's not a dilemma. What will happen is Airbnb will withhold at 5%. So anytime they are paying you, they will pay you minus the 5%. That 5% is actually an advance tax. When you come and calculate your profits and you apply the tax rate, the correct tax rate, for individuals, it differs from 10% all the way to 30%. And sometimes it can go up to 35%. Or you apply a 30% if you're using a company to do the Airbnb business. If the taxes you are supposed to pay are less than the 5% that was collected, you actually apply for your refund. There's a whole procedure on how to apply for refund, and it will be processed within the timelines that Section 47 of the Tax Procedures Act has provided for. So you get your refund because you have overpaid tax. But if your taxes payable are more, then of course you pay the difference between what you're supposed to pay and what has been deducted by Airbnb. So that is how you should operate your taxes as an Airbnb
Thank you very
business.
much.
Yes.
Thank you for making that clarification. And now let's look at dispute resolutions, because there is no engagement that has got no disputes. And in this context, if a trader, disputes your assessment of taxes in one way or the other, what resolution or where do they go? What is the option, that where do they go, or what do they need to know in order to access justice? Should they be aggrieved by KRA's assessment?
Yes, there's a very intricate process of dispute resolution, and that is totally provided for in the law. So if KRA gives you an assessment and you are aggrieved, you have a process called an objection process. So there are timelines. You need to object within 30 days of receiving that assessment. And of course, your objection must be valid. And many people just object for the sake of it, which you then run the risk of your objection being invalidated or being treated as an invalid objection, maybe filed outside the required time. That then behooves you again to go to a higher authority seeking for time to file a late objection. So usually you make sure that you file your objection with all the required evidence. So if KRA says, oh, you are supposed to pay so much tax, we think your bank account has so much, it is upon you to say that, no, you got 1 million in my bank account, 500,000 relate to my business, 500,000 was sent to my sister. But you also have to prove that indeed the amount was sent by your sister, because I'm sure you've seen the latest in the media circles that where you cannot prove where you got the money, then the closest assumption we can always make that it's an undeclared income, which is then subjected to tax. So if that is your case, then you must have evidence that this money was sent by a relative, and again, the fact that it is not subject to further tax. So that is how you do an objection. And if your objection then is valid, the commissioner looks at it and feels that it explains the assessment, then we vacate that assessment. Okay. There are times there where we can agree with you partially. Okay. So we can agree with you partially, we can agree with you totally, or we can differ in totality. So where we differ, partially or totally, then KRA does what we call a confirmation of an assessment. It's provided for within 60 days. So we confirm the assessment where we tell you, based on, remember, it's based on Article 47, the Fair Administrative Action, that we gave you an assessment, you told us this is the issue, but we are not satisfied because of A, B, C, D. And once you get our objection or confirmation of objection, then you have the right now to go to the Tax Appeals Tribunal. Okay. So the Tax Appeals Tribunal then can listen to the case from a third party angle and of course make a determination, because that is now almost judicial, quasi-judicial. But again, during the time you are at the Tax Appeals Tribunal, you are allowed again to come for an ADR. You can sit down and we agree and we thrash out issues and we agree and we finish the case. Of course, then you report back to the TAT that we underwent an ADR process and we've agreed. But if you still don't agree, then you can go to the TAT. If the TAT rules and any of the parties, now it can be KRA or the taxpayer is aggrieved, they can always go to the next appeal level, which is the High Court, of course, all the way to the Supreme Court based on, the legal provisions here. Yeah.
And in your assessment, Nixon, would you say you've had an increase or a decrease in the kinds of disputes that you've gotten so far in relation to the introduction of digital taxation system?
Generally, from taxation of the digital services space, there have been very few objections. Okay. One, it's a new area. Two, it's also not, it's a technical area. But one advantage is that most of the taxpayers are generally very compliant. So that's a very good sign to the Revenue Authority. However, I'm not sure if you've seen the two landmark cases on the digital economy. Maybe as lawyers, when you get time or when you retire, you can quickly look at those cases. There's a case that was decided the other day on Sandy, okay, versus KRA. And there's also the DSTV versus KRA case, where there was an issue of what is a digital service. I think, but that was leaning, the two cases are all leaning towards VAT, but it's not very far from what we do in terms of the digital service tax. So those two cases will give you a feel of how the digital economy looks like. But of course, there are a lot of other things we do in the background, which is not open to the public, in terms of, taxpayers will write and tell you that these are my services. I don't think they fall within the regime of taxation, then of course, then you have to guide them and then tell them either you are not or you are. And in most cases, when you guide them, they are, then they come and pay the tax and you proceed with the compliance process. Yes.
Oh, thank you very much. It seems digital taxation is making life easier. And perhaps now let's talk to the future of digital taxation, and we will be concluding in this section. Nixon, maybe you can educate us. How much revenue has digital taxation contributed to our economy? And is this within what the KRA had anticipated?
I know we've done better than what we projected, but we can always perform above that.
Yeah.
Remember, in Kenya, the digital taxation regime is specifically ring-fenced to non-residents. But when you look at digital economy in general, it's a very huge economy because it touches on both residents and non-residents. Kenyans are selling things online. Kenyans are on TikTok, they are on Twitter, they are on Instagram, they are on YouTube. You know, some of that is not counted from what we collect. But in total, if you were to count it, it will be a lot of money. But specifically in relation to significant economic presence tax and digital service tax, currently Kenya has collected about 4.5 billion since it started. But there's also VAT from the same services, which currently stands at about 50 billion. And you see the amounts are huge. There's also digital asset tax, where, of course, during the period it was in place, there was over 1 billion that was collected. And more, I think we are still working with some of the providers to pay what they didn't pay. We are working on that space. There's also even excise duty that was introduced last year on 27th of December 2024, which again is also adding to the same basket. So you look at in totality of that amount, you look at excess of 50 billion in the last 5 years that the specific regimes have been in place. And these are monies from non-residents. So we are not taking into account residents' residential provision of digital services.
And when you project 10 years to come, what would be the vision of digital taxation in Kenya?
You know, Mwalimu, one of our, one of the core mantra at the National Treasury is to also enhance stability in taxation regime. So going forward, I don't see a lot of changes. I only see stability in terms of the tax regimes, stability in rates, not changing, from this to that. And therefore, as more players come into the net, of course, as more youths also consume the digital services, then we can only collect more taxes from that. So that is what we project, but much more. One, close collaboration with the taxpayers and the industry players. I think that is critical for the success of not just collecting of tax, but also success of the digital economy in general. And then number two, of course, to also come up with the tools like the ones we mentioned, which are capable of validating how much we are collecting. I think those tools are very necessary. Maybe algorithm based. We'll be seeking your assistance to give us such a system, plus many other tools that are available in the market, just to ensure that if the law says I need to pay 5, I should actually pay 5 and not more and not less. Yeah.
Wow, thank you very much. I can't stop listening to this, but nonetheless, we have to come to an end. Just one message, for young or online traders, both nationals and foreigners. What advice would you give to these young people who want to start business entirely online?
So for the young people who want to start business online, or even non-residents who want to start providing their services in Kenya, KRA's role is to facilitate you because the law is already there. Where you are exempt, we will actually educate you and assist you to say, this is where you are exempt. Where you are supposed to pay, we will also assist you and facilitate you to pay, even assist you to compute how much you are supposed to pay, when to pay, and even how to pay, because we have
Yeah.
sessions where we even educate our taxpayers on how to navigate the iTax system in a bid to enhance compliance. So it is always good to seek our opinion, seek our facilitation, but you're also open to get consultants. Okay, there are some providers who might be so huge, they need the role of consultants. But again, always important to come to us for validating such information, and as we are generally there to facilitate you. The number two, as good citizens in line with the Constitution, all of us have to bear our fair share of the tax. Remember what Article 210 says, and also 209 on the use of resources in Kenya. We have to pay our fair share of taxes, because that is the only way that we ensure that our country is developed, and we also have something to leave for the generations to come. And of course, and in line with using the resources prudently, it also involves the collection of the right amount of taxes. And then finally, if you look at taxes in an economic sense, taxes do not stifle business. Instead, it makes businesses more efficient. In fact, Mwalimu, if you look at the role of even the use of eTIMS, the electronic tax invoice management system, it is a system that is not just giving the taxman visibility of transactions, but it's also a system that businesses themselves can use just to see how well they are doing. It has even simplified the process of filing returns, because now we have your transaction information, and that's why we went into what we call the auto-populated returns. So it is also important for businesses, finally, to do business with the right people, with genuine taxpayers. You can always confirm that you're dealing with a good taxpayer who is also accounting for their taxes. You don't buy something from a taxpayer who doesn't give you an electronic invoice, and then tomorrow you want to claim that as an expenditure. The law will not allow you to do that. So I think that is very important for our youth who are also doing business. But above all, KRA is there to facilitate them comply with the tax laws.
Okay, thank you very much, Nixon. And now we will take a few questions from the chat box. And you stopped at the eTIMS, and that's where the first question is coming from by Sheila Bahati. How does eTIMS work, and why is it mandatory for its registration before issuing a TCC, and the taxpayer individual is not involved in sale of goods and or services?
Mwalimu, if you look at the issue of electronic invoicing, because it is the law, if you look at Section 23A of the Tax Procedures Act, it says that all transactions, all businesses then must issue an electronic invoice upon the sale. Okay?
Yeah.
As a way of ensuring that you and me all ensure that we issue electronic invoice. If you're in the business space, remember, for employees, they don't issue electronic invoices. And therefore, if you have only been filing an employment-only return, you will not be forced to join, to ensure that you're on eTIMS before the TCC. But if you have been in business, then the only solution we have is that if you're in business, then you must be issuing invoices. And when you're issuing invoices, the law requires that you issue invoices from the electronic invoicing management system. And that's why we require you, before we give you a TCC, to ensure that you're already on eTIMS as a way of enhancing compliance for all of us. And remember, Mwalimu, even myself, I'm not precluded from the electronic invoicing management system. It's a tool for all of us to ensure that all of us contribute our fair share. Not to punish anyone, but just to enhance compliance with the various tax laws. As to how the eTIMS work, sorry, Mwalimu, I might not delve into the intricacies, but I want to point our very good listener, there are a lot of videos we have even in YouTube and also in the KRA website, including step-by-step guides. They can use those materials just to guide them on how eTIMS operate. Thank you. Yes.
Yeah, thank you very much. And sorry, I think I overlooked the first question. where Shayla says, what a beautiful Monday to learn about taxation. I have so many questions, but first of all, does Kenya adhere to canons of taxation? Because some taxpayers allege that they are being taxed double. So these are the instances of double taxation.
Mwalimu, you know, there are many types of double taxation, but allow me to speak to the most common one, which is called juridical double taxation. That's an international language. Juridical taxation is where you are taxed on the same income, you are the same person twice, but in two different countries. Okay? So the law already provides that if you earn some income from Uganda, for example, today, and you've paid tax in Uganda, the law allows you to come and claim back the taxes you paid in Uganda as a credit before you are taxed. The only difference will be how to treat that credit based on the income. For example, if today I got some employment in Uganda and I've been taxed, as a Kenyan resident, I need to still declare the same income here. Whatever was taxed in Uganda, I credit it against the taxes I'm supposed to pay in Kenya. So that is one instance. As to whether multiplicity of taxes amounts to double tax, I think that is Adam Smith's own economic model, that we must have a number of taxes in order to ensure that every activity within the economic ecosystem is captured. If you're going to spend, then something catches up with you in terms of consumption tax. If you are going to earn, what we call creation of wealth, you're either doing business, you are in employment, you are a mechanic, you are constructing, then you pay corporate income tax. If you decided to buy an asset and keep it as it appreciates in price, when you do sell that asset, then there will be a capital gains tax upon the sale of that asset. So that multiplicity of taxes actually follows the canons of taxation by Adam Smith, and that canon is about productivity and also ensuring that everybody comes into the tax net. So I'm sure it follows. And where there's double taxation, there's always reprieve in terms of credits against whatever was already taxed.
Okay, another interesting question from Sheila Bahati. Why was filing of nil returns scrapped off, and some taxpayers have nothing to file? In fact, the PIN is yet to ever benefit them.
Malim, I don't know whether I should answer this or not in the line of what we are discussing on the digital taxation. But just a brief is that there are people who we've realized they misuse their PIN to perpetuate tax avoidance, or some people will even say tax evasion. So when we realize those incidences, that is when we stop you from using your PIN. But as the issue of nil filing, why we stopped the nil filing was to assist us to have a simplified and easier mechanism for the nil filers. So what we are doing is to develop an easier way of doing nil filing, and also to increase capacity. If you allow everybody to file on the same date, that is when you realize the predicament we got into last year. You remember, on the last day of filing, when our servers could not hold all that number. So we are trying to make sure that people can file on different dates to have enough room. But above all, of course, the nil filers are now able to file. But if you are filing nil, make sure you are actually a nil filer. Know that you are filing nil and you have some income that you have not declared to KRA. So I think that is also important as a take home. Yes.
Yeah. Okay, Michelle says, thanks, Dr. Sala, for this yet another educative forum with our distinguished guest. Be blessed. Shayla says, my thoughts, taxpayers have no problem with paying tax. The issue is how the tax is spent. Do you get value for the tax they pay? Any KRA is only a collecting agent and doesn't decide on expenditure. I think that's more of a comment.
Yeah, it's a very fair
Unless you
comment.
want to.
So no, I wouldn't want to talk about it because she's done it justice with that comment.
Okay. And then another one, kindly note that the condition precedent for TCC issue is affecting individuals and new companies, and KRA needs to look into it.
Definitely, we are looking at the issue of e-teams and TCC, but I can assure you the process of onboarding TCC is very simple. It doesn't entail any payment of tax. So I would urge anybody with a company or who has had business income before, just onboard the e-team system. Then within a day or two, you'll have your TCC. It shouldn't be a big deal. It's just a process.
Okay. So thank you very much, Nixon Omondi. We truly appreciate your presence on this talk tonight. It's been a great conversation, very enlightening. I'm sure the audience have also learned so much. So we just want to appreciate you and say thank you. And now over to you for your final closing remarks.
Thank you very much. I think it's some very good questions here that got me to think on my feet. But as you've seen, as the digital economy grows, then of course, more taxes are collected in that space. Very important also to note that the way we treat our residents is exactly the same way we should also treat non-residents. In light with we all know the UN Convention on the issue of discrimination is also contained in international tax documents. So if you are taxing your residents, why would we leave the non-residents untaxed? So taxation of the digital economy goes into the heart of non-discrimination, treating people equally. And of course, that also speaks to our constitution as well. Above all, I think I would just urge all of us to be good citizens. Let us do our patriotic civic duties. Where we need to pay, we pay. Declare all. I think sometimes it's very uncomfortable when KRA unearth some other information that you do not give, or some income that you did not declare. And then now the process becomes tedious and sometimes very uncomfortable. So please just declare all. And for those who are filing returns, we're already in the filing season. I just urge that we start early. Mapema ndio best. Thank you.
And there's no need to declare. So anyway, thank you very much, Nixon. We truly appreciate once again. And that brings us to the end of this program tonight. Thank you and God bless you. Thank you to the audience as well.
Thank you.
It's a
God bless you
pleasure
too.
to have had you. Yeah. For the audience, you're most welcome another time. Please subscribe and let us continue having these great conversations from great people like the one we had tonight. Thank you.